Welcome back to the second edition of the Kansas City Commercial Real Estate Market Pulse, hosted by Exchange Commercial Real Estate. Today, I am joined by Nathan. Nathan, what's going on today, man?
Yeah, not much, man. Just been staying busy, trying to put together some BOVs, but that's kind of been the latest with me recently.
Awesome. It really does feel like, and we'll talk about this today, but it really does start to feel like some momentum is starting to pick back up. And we've got a lot of good data as well as some education today to cover. You know, I think that one thing that we enjoy doing is talking to property owners and testing out educational type of content, such as what we're going to speak about today, like return on equity. So we have a lot of different slides and breakdowns of return on equity. And Max McQueen is joining us. Max, how are we doing today, my friend?
How goes it, gentlemen?
We're doing great. We are doing great. Thanks for being here. We're just getting started. So let's just kind of overview why we started this. You know, there's really a need, I think, in Kansas City, in many markets, but in Kansas City specifically, for valuable, up-to-date information. Like most of the market reports that we typically see are from the last 90 days or the last quarter, and those are coming out, 60 to 90 days into the next quarter. So you've always got this rear view mirror type of looking, and it's really hard to see, okay, well, what is actually going on right now in today's market with the people who are transacting. And so this is a forward-looking windshield, going through the windshield, looking forward of the Kansas City commercial real estate market, including any notable transactions, any market trends, any expert insights and educational content like we're bringing here today as well. So our team is listed here. I'm the managing broker, Logan Freeman. Thanks for joining us here today. Micah, Nathan, and Katie were with us last week. Nick is headed out on vacation, so we're joined today by Max and Nathan. Really quickly, guys, just tell the audience what you focus on and what your niche is in Kansas City. So if anyone wants to get in touch with you, they know why they should.
Go ahead, Nathan.
All right. Yeah. So I focus on owner, user, and investment sales and leasing, primarily for multi-tenant retail, flex industrial, and office space.
Fantastic. What about you, Max?
Yeah, I'm over on the multifamily acquisition side. So buying or selling in the multifamily world, that is right where I'm at.
Excellent. So if you are interested in talking with Max or with Nathan, just reach out to those guys on LinkedIn, and or their emails and information should be on this slide deck. So moving on. All right, this is an exciting slide for us to kind of cover, guys. And we're going to do a roundtable type of conversation here. But what I have done is pulled Kansas City specific information and looking at all of the demographic and economic markers that we get asked about all of the time. And it's really nice to see these all on one page. So this is covering several important metrics. So we've got population growth, we've got net migration, GDP growth compared to the national average, job creation, and unemployment rates. You know, one of the things that really stood out to me, right, was in Kansas City, people are like, why or are people moving to Kansas City? And I have long said Kansas City has always been really a steady market, anywhere between 0.2 to 1% population growth, and 1% being at the highest level than we have ever seen. We're right in line with the national average of 0.4%. We did see a little bit higher averages during COVID, right? I mean, a lot of people were able to work remotely, and they were looking for places that were more affordable to live, but also had a really nice living standard. And in Kansas City and the surrounding metropolitan statistical area, you can get a lot in a big bang for your buck. And so there's a lot of cool things happening in Kansas City, but I do think the one thing that keeps away a lot of people is our harsh climate. And what I mean by harsh climate is, we really get cold and we really get hot. I mean, there's not really any day that I can remember that I can just go outside and not sweat or not need a coat, right? We have a little bit of a spring and a little bit of a fall, but a lot of times those are intermingled with winter and with summertime. So population growth being right at 0.4%. But one thing that I loved to see, right, was what is the economic growth happening in Kansas City, right? We got 9.3% of GDP growth, and that beats the national average by 0.2%. And I think that is really important because this growth reflects the overall expansion of the local economy, right? It's driven by diverse sectors such as technology, healthcare, manufacturing, agriculture, and the list goes on and on. So a growing GDP typically leads to more business opportunities and a stronger job market, which really fuels the commercial real estate industry, right? And so we spoke about last week a lot of the really notable developments happening in Kansas City. And I'm going to pass the baton here to Nathan because recently, Nathan, you were posting on LinkedIn about some of the top developments that were exciting for you. So just talk to us a little bit more about how you're seeing some of those developments in regards to GDP growth and what that means for investors and folks that are looking at commercial real estate here.
Yeah, so I mean, like you just said, I mean, there's a lot of development going on around Kansas City. What that's going to lead to is some GDP growth, and how that is because when consumers are spending more money, I mean, that just circulates around the economy, especially here for KC. As far as what I'm seeing, there's just significant demand for retail space in certain property types here in KC. I mean, when things are hitting the market for retail space, they're getting leased up pretty fast. And really, that's just going to be an ongoing trend, especially around some of those developments, those key developments here in KC.
Yeah, absolutely. And we'll talk on retail more specifically here very soon. Max, when somebody says, hey, where is Kansas City and why the heck should I invest in commercial real estate there? How do you respond to that, man? I mean, what gets you excited about Kansas City going on? We've got all the markers here, and I'll touch on a few more of them here shortly, but you speak with a lot of out-of-state buyers that are looking to enter into Kansas City. So, pitch us on why we should invest here in Kansas City.
Yeah, it's funny you say that, Logan, because I was thinking this morning of just investors I've talked to in the last month. And you've got, New York, California, Texas, everything's coming inland. And I love to hear from an outside lens. Obviously, I'm in the city, but why are people coming here? And outside of the market just performing steady, there just seems to be a lot, which tails right into Nathan's world, the development side of things. I mean, you have a lot of buzz happening here in the city. And it seems to be the play that everybody's approaching on the multifamily side is value add. Money right now is not cheap to borrow. So people are wanting to get in with these value add opportunities, stabilize the property and keep things moving. So there's
Absolutely.
a lot of opportunity. Yeah.
Right on. So in summary, I would say this, right? The key demographic and economic markers indicate that Kansas City is a growing and a dynamic market. The positive trends in population growth, net migration, GDP growth, job creation, and relatively low unemployment rates, right? 3.1% compared to 3.9% in February of 2024, all point to a strong and resilient economy. And people are looking for stability, especially in today's day and age. And Kansas City can provide that. So for investors and for businesses, these factors make Kansas City an attractive location for investment and expansion. And so we are ready and we are willing and able to help you find either your next investment opportunity, sell your investment opportunity, as we're going to speak about how to unlock your return on equity here today, into finding your next opportunity as well. And if you're a business owner or you're an owner user looking for your next space, definitely reach out to us and we'll give you our insights to what we're seeing. Moving on to the Kansas City retail report, right? The retail sector continues to have the tightest availability conditions in the CRE market, right? Only 4.7% of retail space is currently available for lease, and that's the lowest on record. So due to limited availability, the vacancy rate's still hanging out around 4%. Right. And that's even though net absorption has slowed down further in May of this year. So, but specifically in the last 12 months, demand for retail spaces has increased by nearly 39 million square feet compared to 57 million square feet a year earlier. So with new construction deliveries diminishing even further, the fundamentals of this sector, I believe, and we believe, are expected to remain tight in 2024. In Kansas City specifically, demand for retail space is stronger than nationwide, as this area in Kansas City has a faster absorption of retail space. And that's all because of what we've talked about with population growth, with new jobs being created, new developments happening, right? You have sort of the Google effect or the Amazon effect. When they move their headquarters somewhere, all of these other businesses and or multifamily properties and retail and industrial want to be around those areas so they can service those areas. But Nathan, you're specifically focused on the retail side and you're in this business on a regular basis, man. Anything stand out to you, or was this a surprise to you at all?
It's not really surprising. I mean, really with net absorption, it's the difference between what came available and what actually got leased within a 12-month period. There's just high demand for that space. I mean, spaces like that, especially I would say that 1 to 5,000 square foot range is just getting leased up within a few months. So that's not really that surprising, just knowing with increasing consumer spending just the past few years. I mean, this is kind of directly on line with what people could have forecast.
What do you think are some of the top businesses that are leasing out spaces right now? Like, what is creating the demand? And it doesn't have to be specific businesses, but maybe, industry specific, right? Like, what is driving that demand in the retail sector?
Yeah, I would say, I mean, and this is just some thought. I would say during COVID, when a lot of people were at home, a lot of people were putting together business plans and trying to figure out what they can do to, I guess, kind of get on that entrepreneurial side. I mean, there's been just more startup businesses or more new businesses being created between 2020 and 2022 than any other 2-year span in history. I think that's really what's leading to this, along with people wanting more experiential type of retail. Really, those are the two demand drivers that I think is keeping retail at a flux and just with that much demand. So
yeah, but Nathan, I've been seeing the headlines about CVS and Rite Aid and Walgreens specifically dropping out of the industry or closing 2,500 or 4,000 stores. What would you say to that?
Yeah, I mean, with CVS in particular and those type of organizations, I mean, it's changing consumer spending on how they're going about getting certain products. So, I mean, the Amazon effect is definitely taking a toll on certain retail, particularly CVS. I mean, when it comes to getting pharmaceuticals, I mean, you can go online through Amazon and get that literally shipped within 24 hours compared to having to leave your house or whatever to go to the store and get that picked up. And then it's a matter of, do they actually have that in stock? Yeah. So I think it's just changing certain things, like certain things that I'm going to buy online. I'd rather do that than actually go physically in the store and search for it to see if it's even there.
And let's not forget that every $4 out of every $5 in retail, 4 of those dollars are spent in brick and mortar. Mm-hmm. 4 out of $5 still spent in brick and mortar. So the absorption in regards to retail still very strong, very interesting. And I love tracking supply and demand because retail has not been built, and specifically around great locations such as neighborhoods, retail has not been built. So if you have spaces like that, they are leasing up fast and they are becoming a really hot item in regards to investments. Moving on to industrial, right? I mean, look, I'm not here to tell, why you should invest in Kansas City. I'm here to give you the facts. We're here to give you the facts. And demand for industrial space in Kansas City is actually weaker than nationwide, as this area does have a slower absorption of industrial space. I think, and we'll dive into this with Nathan, but I do think this has to do because of all of the new supply that has come online. In regards to that, we were fundamentally underbuilt on the industrial side. And so during COVID, we saw big developers. I mean, millions and millions of square feet be developed. And so that is another component of supply and demand. But I will tell you, just from being an owner on the industrial side myself, the demand for space under 20,000 square feet, or maybe even under 50,000 square feet, still very high, specifically if you have a flex component where you can have your office and your manufacturing or your warehousing in one building. But, Nathan, was this surprising to you when you saw, the demand here in Kansas City weaker than the nationwide averages?
Not really. I mean, like you hinted on, I mean, you kind of took some of those talking points there. Really with industrial, I mean, it's huge logistics in warehouse space that's being built. I mean, they're in the millions of square feet. I mean, what's in high demand for industrial space is what you just mentioned. It's the flex space that's going to be a few thousand up to about 20,000 square feet. Yeah. Those are getting leased out pretty fast. Everything that you're even seeing as far as sublet space that's coming on the market, it's 50,000 square feet and above, primarily because it's these huge distribution type of organizations or tenants that realize that they actually didn't need that much space, and now they're subletting it to smaller organizations, even though they're 50,000 square foot spaces. And that's really the ice on the cake. I mean, it's really just been so much development and supply just being significantly above what that demand is for those larger warehouse and logistic hubs.
Look, the absorption rate for the last 12 months is still at 98.5 million square feet nationwide. Okay. So, but deliveries are still outpacing the absorption to a 4-to-1 ratio. So look, I mean, the vacancy is still at 6.5% in the industrial side. So we're not talking anything in regards, we're not even close to double digits on the industrial side. And I think developers are already reformatting the way that they are thinking about delivering these new spaces to meet the demand of these smaller spaces. So great overviews there. I really appreciate that. Let's talk about the commercial real estate lending environment. Debt continues to increase, and despite higher interest rates, commercial real estate debt is still on the rise this year, specifically within small domestically chartered commercial banks. The volume of commercial real estate loans has surpassed $2 trillion. This is an increase from the $1.9 trillion April of 2023, following the collapse, as we all know, of two regional main banks. However, within the large domestically chartered banks, the volume of CRE loans continues to drop, hovering around $872 billion. So thinking about that, it's like, okay, well, what's happening in the industry around delinquency and increasing commercial real estate delinquency rates, but they're still historically low. Okay, the Federal Reserve also provides data on delinquency rates for both commercial real estate and residential loans. And according to that last data, the commercial loans consistently maintain lower delinquency rates compared to residential loans. Specifically, the commercial real estate delinquency rate was 0.77% in Q1 of 2023, and currently it stands at 1.18%. Yeah. So, delving into historical records, the delinquency rate has stayed consistently historically low. Now, and I also think if you go and actually break this out into specific asset classes, we're going to see a lot of this being in the office sector. All right.
And I would say to add some context there, even though delinquencies are increasing, they're increasing at a much slower pace than I would say the 24-month period previous. Yes. I mean, it's still increasing, just not at that fast of a rate.
Yeah. And why we talk about commercial real estate debt is important because it's usually the largest cap stack, item when you're going to purchase a building. So we need to know what the leverage point's going to be, what the rate's going to be, what if you're going to get any interest only or not for these different types of deals. And it really specifically, it just changes depending on your asset class and your business plan that you have for each one of these deals. Now, our team is well-versed in working with mortgage bankers that can bring you multiple different options, as well as we have relationships with over 25 banks here in Kansas City that we can make introductions for, just specifically, in regards to your specific opportunity. We can go CMBS route, we can go SBA route, we can go regional bank. There's a lot of different options in regards to commercial real estate loans, and it's a big component to be thinking about, especially if you're looking at this from an investment standpoint. All right, moving on to the multifamily demand, right? I mean, this is impressive. So check this out. Some 390,000 apartment units were absorbed on net over the past 12 months. And that's according to RealPage. So dating back to the start of the new millennium, this latest annual reading ranks as the 8th largest figure on record. Only the pandemic era boom from mid 2021 to mid 2022, year ending, which is the third quarter of 2018, and the year ending fourth quarter of 2000 figures outpaced that of the last 12 months. But perhaps the most impressive within the context of the pandemic era boom is how many units have been absorbed year to date. Some 257,000 units have been absorbed during the first two quarters of 2024. That's essentially in line with the all-time high set in the pandemic era demand, which saw about 270,000 units absorbed in the first half of 2021. So while that gap is continually closing, right, record supply continues to moderately outpace demand. More than 500,000 new market rate apartments units delivered in the past 12 months. That represents a 45% increase from the same time horizon in the previous 12-month period, right? So that's a big number to be thinking about. Considering an additional 629,000 market rate apartments are expected to deliver in the next 12 months, headlines will most likely continue to focus on supply side fundamentals. Just like the commercial real estate debt delinquencies, we have to go past these headlines, though. Where are the units actually being developed, right? And in Kansas City specifically, one thing I wanted to point out is Kansas City, most of the time, is top 5 on apartment rent growth leaders year over year, right? So on this list, we're number 1 for market rent growth in the second quarter of 2024. This isn't just a fluke, guys. It's a testament to the robust demand and strong absorption rates that we're seeing across the United States, with the Midwest standing out. Some of the key findings from the latest RealPage report, right? We've got unprecedented rent growth. We're at the forefront, leading the nation's average, somewhere between 3.5 to 4%, depending on which report you're looking at. We got strong demand all across the nation, and we got stable occupancy rates, right? So I think that right now, investors, talking to you, now is the time to capitalize on this growth, right? Kansas City is not just growing, it's thriving. And that's really important to remember. Max, thoughts on Kansas City supply, demand, and the rent growth, man? I mean, what stood out to you when you were looking into this RealPage report?
Yeah, I mean, I think it's interesting, Logan, like you said, that Kansas City consistently in the top 5, and specifically in the last quarter being in the top 1. It's putting Kansas City on a map that I don't think it's ever seen before in regards to demand. And that's been a unique lens to look through as I'm having conversations with these big hitters from coast. And Texas is a generally sought after market. And I'm starting to see why they're pushing their money and capital out here to the city. And then, like you said, 390,000 units being absorbed in that short time frame, only competing with the pandemic era. I think it's speaking to itself nationally that people are wanting to capitalize on multifamily, because owning a home right now just seems to be pretty pricey compared to what it normally is.
Yeah, most definitely, man. And I also think that, like, in Kansas City specifically, you have to remember that there are certain pockets, just like any other market, that you want to be aware of. And if you need more information on where you should be focused on, I have a slide here at the end of this presentation where we created a free email education program called the Kansas City Deal Navigator that can help you understand the right areas to be investing in and where the growth is happening. And we'll have a link to that here shortly. Thought this was great from Visual Capitalists, right? The best states to do business in, right? New York, Texas, and California may steal the spotlight, but there's an underdog rising. The Midwest, specifically Missouri and Kansas, it's quietly becoming a business powerhouse. And like I said, steady Eddie, right? So you got Kansas at 21, you got Missouri at 25. Just north, we've got either Nebraska and Iowa. This is a little small on my screen. I can't see exactly, but 7 and 12, right? So those are right in line with where people would want to be here in the Midwest. So, why are these states on every savvy business leader's radar? Well, first, I think it's the cost advantage. Missouri and Kansas offer some of the lowest business operation costs in the country. So why does that work? Well, you got lower costs, meaning higher profit margins. Affordable real estate provides room for expansion. And then competitive wage rates attracts businesses without sacrificing talent. Second, you got to tap into that talent. Both states boast a skilled, educated workforce. We have universities and colleges ready that are producing job-ready graduates, lower living costs retaining that talent, and growing technology and healthcare sectors provide specialized skills. Third, embrace the central location. The Midwest is a logistical dream because it's centrally located for distribution. We have major highways and airports for easy travel and the proximity to both coasts for balanced trade. You can get to anywhere in the continental United States by truck in 2 days from Kansas City. Fourth, you got to leverage the business friendly environment. So you need to be looking for states that have policies and incentives that are designed to attract and retain businesses. And then lastly, I would say enjoying the quality of life. We have a high standard of living without the big city stress. And we hear that over and over again. One of the things that people were asking me after I posted that on LinkedIn is, well, how is this calculated? Well, here's the weighted different categories, right? So you've got the workforce, infrastructure, cost of doing business, the economy, you've got technology, business friendliness, education, access to capital, and cost of living. So they took an algorithm, put that together, and then populated these top states with, I believe, South Carolina or North Carolina, maybe it's North Carolina being number one in the country. And I just love to see this because it's really cool because in this, we are, again, not going to be the tops, right? What do we got? Up there, we got Texas, we got North Carolina, some other states, maybe Michigan, up there in the top ones. We're always flying right there, mid-level, under the radar, steady Eddie. And this is exactly why this is a good spot to be doing business in. All right, guys, before we jump into educating around return on equity, what did I miss? What have we not covered in those past slides? Any talking points that you guys had that we kind of glossed over, or anything we need to dive into just a little bit more in detail?
I was just going to say high level. I do see Kansas and Missouri moving up on that list, definitely in the foreseeable future, primarily because we are having some changing zoning or regulations for new development in certain submarkets of KC. For example, Prairie Village, which hasn't been that adamant on having new development for multifamily. I just recently seen a change with their zoning on how you can have multifamily in commercial districts, and that had to be approved through the city prior. Obviously, you still have to get approval with getting certain things through, like with the code, but that is not a requirement for to be strictly a residential zoning to build multifamily now in Prairie Village. And I think that's probably going to circulate around different metros or submarkets in KC.
Absolutely. Great point to be made there. Return on equity, right? When we're talking about looking at a commercial real estate investment deal, there's internal rate of return, there's cash on cash, there's return on investment, equity multiplier, there is average rate of return. All of these different acronyms and return metrics that people are looking at. But similarly, how Missouri and Kansas fly under the radar, I think return on equity flies under the radar. And we want to bring this education to the masses here because we're having great conversations with property owners on how to understand truly what is their return on equity and how to unlock that. It's commonly used by investors to measure a company's profitability and efficiency in generating profits. In CRE, return on equity is the rate of return that you get from the investment as in generated by a total return against your current equity position in the property. Okay, so a simple way to look at this is just looking at profit divided by equity. An advanced way, and we're going to cover both of these, is total return divided by your current equity. And I thought that the Massimo Group did a phenomenal job writing an article about return on equity, Max. And I want to bring you up here just to speak about this because I know you're reading it every single day. But tell us, somebody that's newer to the business, moving from the residential to the multifamily side, what was it about ROE that really stood out to you in that article?
Yeah, I think this article, Logan, was an incredible read. And if you have a chance to read it, go read it. But what I like is it extracts all the fluff. Like you said, all those indicators that people generally look at, your cash on cash, your internal rate of return, your cap rate, all valuable for a single property. But while those may be increasing and it looks like in an upward trend that you're leveraging, in reality, it might not be the most efficient way to be leveraging your money. And so
Yeah,
this article just dives into that, and I love how it explains it.
absolutely. And so let's go into this, right? Let's figure out how to explain this, because internal rate of return is extremely dependent on your terminal cap rate. So you can make an internal rate of return from 15% to 20%, saying I'm going to sell it at a 6% cap rate versus a 6.5% cap rate, right? Return on equity, you can't do that, right? It's what is the total return you're getting from your equity in the project. So what I'd like to do is explain this to a fifth grader. So let's imagine that you have a lemonade stand. You and your friends put together $10 to start a lemonade stand. This is your starting money, or what we're going to call equity. After selling lemonade for a week, you have $2 in profit. So after paying for lemons and sugar and cups, you have $2 more than what you started with. So now, to calculate your return on equity, you want to see how well your lemonade stand is doing compared to the money you put in. Well, ROE helps you understand this. So simply, to find this, you divide the profit, which is $2, divided by the starting money, which is $10, right? And so this is going to say that basically you made 20% of your starting money back in profit. So a 20% ROE here means that for every dollar that you put in your lemonade stand, you made 20 cents in profit. So in summary, equity is the money you start with or you have in the project. Profit's the money you make after selling your lemonade, and return on equity shows how much profit you made compared to your starting money. All right. So let's apply that to the commercial real estate space, right? And here's a conversation that we're having on a regular basis with property owners, right? It's like, can you tell us just the amount of you initially invested in the property? In this scenario, $500,000. Great. And do you have an estimate of the current market value? Well, I think it's valued around $1.2 million. A lot of times, this is where we will step in and really help give a broker opinion of value on what the value actually is. Because a lot of times we find that property owners don't know that their property actually is selling for $180 per square foot, and they may have $70 per square foot on their basis, right? So we can definitely help understanding what your value of your commercial real estate property is. Next, we go to expenses, right? So what about the net operating income after expenses? It's about $60,000 per year. Okay, and then what's the current mortgage balance? Okay, they owe $400,000 on the project. So we can simply calculate return on equity as 7.5% here, right? We have the calculation here at the bottom. And so you just take the current equity, which is 1.2 million minus your mortgage balance of $400,000, and you get $800,000. Your NOI, your net operating income, is $60,000. We divide that by the current equity to get our 7.5% return on equity. So that's how we're going to apply this in the commercial real estate space. Going a little bit more in depth, right? We do these calculations on the fly with property owners, and that's really where we leave that. But we love to go really deep and actually understand the advanced return on equity, right? So this is going to calculate the total return, which is the NOI plus your principal reduction and your annual appreciation divided by your depreciation. So that's our total return. And then our current equity being our market value minus your debt minus your selling costs. Okay. So in this scenario, we have initial purchase of $1 million. The annual NOI is $80,000. Our expected appreciation is 3%. Our total return for this deal on return on equity is 11%, right? 110,000 divided by $1 million. And we go after our appreciation. So this is where we create these gaps for property owners that they did not realize that their return on equity has gone down because their appreciation, their property has appreciated faster than their NOI has increased. So let's say that the new property value is $1.5 million. The new annual NOI is $90,000. Expected appreciation of 3%. Our cost of sale is 5%. So our current equity is going to be $1.5 million minus $75,000. And our total return is going to be our NOI plus our appreciation, which equals $135,000. So our new ROE in this scenario is 9.5%. And here's where, when we're talking with property owners, the light bulb goes off. Oh my goodness. I have owned this deal for 5-6 years. My NOI has only increased by $10,000, but my equity has gone up $500,000. And so my ROE, which was at an acceptable level of 11% when I purchased the deal, is now at 9.5%. And this is a way to really walk through property owners on what is your total return on the equity that you have in this project. And when we go through this conversation, a lot of people are like, how can that be? This is crazy. I mean, I just I've never even thought about it this way. But this is allowing you to really understand your return on the equity that you have in the project, because Kansas City and other markets have appreciated, right? And a lot of times, you might see in a multifamily property, rents when they purchased the deal were $750, and organic rent growth has now allowed for $850. Or on a neighborhood retail shopping center, you might have been getting $13 per square foot, and on new leases, you're signing them at $15 per square foot, right? And so while that is good, a lot of times the appreciation just by holding on to real estate, we always talk about commercial real estate being the ideal investment. It can provide income, depreciation, equity buildup, appreciation, and leverage. We can use leverage. And we're going to talk about all those components here going forward. And it's the ideal investment because a lot of times the deal might have appreciated, but your NOI, because of whatever reason, you may not be pushing rents where you think they could go, has stayed pretty stagnant. And this allows you to get a really good feel on that. So thinking about benchmarks, right? What is a good ROE, right? For residential properties, typically a good return on an equity is going to be somewhere between 8 to 12%. Okay. On commercial properties, we want to see that somewhere between 10 and 15%. And then high performing investments, this could be office buildings, retail spaces, industrial properties that are leasing up or just now, just delivered. You really want to see a higher return on equity. And that can range anywhere from 12 to 16%, but usually above 15%. These are going to be more of your opportunistic and or development deals because you are taking on more risk, right, of delivering a new space. And so you definitely want to have a higher return on equity. Something we talk about a lot, especially with new development opportunities, is yield on cost, right? Yield on cost. I'm throwing another return metric at everybody, but yield on cost being your stabilized NOI divided by your total project cost. Okay, that's going to give us a figure. That figure subtracted from the market cap rate is going to be what's called the developer spread. And that developer spread, depending on what type of investment it is, needs to be at a certain benchmark, usually 250 to 500 basis points, right? And so I like to look at yield on cost as well, especially with these high performing investments, either opportunistic or big lease up, historic readaptive use projects or development projects, to understand what my yield on cost is going to be. There's a lot of considerations to take into account with return on equity, right? You're going to have to think about market conditions. They play a significant role. Understanding local market trends such as rental demand, supply, economic factors, those can all help to make strategic decisions to optimize ROE, which is why you need to be speaking to guys like Max and Nathan, because they are in the market on a regular basis and can bring that knowledge from the market conditions to you to help play into your decision if you need to unlock this ROE or not. Operational efficiency is another one. Leverage, we've talked about, right? Utilizing leverage. We're seeing more and more investors use less and less leverage and accepting lower returns for lower risk right now. And I think that's going to be a trend that continues to happen in the multifamily and the commercial real estate space. But property type and location is also very important here because, look, the demand for a neighborhood retail center in a high traffic area is going to be a lot more than if you're in a submarket that has actually population decline, right? So understanding that is very important in regards to your ROE. Well, why can your ROE actually drop? Well, I've touched on this just a little bit, but even though your property has appreciated and your rental income might have increased, your ROE can drop if your equity grows faster than your returns. This means that your property might not be working as efficiently for you as it could be, right? So it could be increased in value, but your cash flow did not keep pace. This is a common scenario, especially with long-term leases. So as a result, that efficiency of that investment has essentially decreased. And this is why this is an essential component to understanding the value of return on equity, because it uses equity as a signal when you are experiencing a diminishing return on your investment. It matters because it tells you whether or not you're optimizing your investment returns and if it's time to refinance, to sell, or to exchange your property to optimize investment returns. None of the other commonly used metrics provide this insight. And this is where ROE really stands out and shines and provides instant clarity. How do we unlock ROE for growth? Well, let's take a look at an example, right? And I love this example because you can unlock your ROE using a 1031 exchange. Our commercial real estate brokerage is called XChange Commercial Real Estate for a reason. We can help you through the 1031 exchange process, okay? So looking at this, a 1031 exchange allows you to defer capital gains by reinvesting the proceeds from the sale of the original property into a new like-kind property. We're experts in what like-kind actually means and all the rules and regulations. So please, if you're thinking about selling or you're under contract to sell, make sure to reach out to us and we will walk you through the 1031 exchange process. We have some of the top qualified intermediaries. We have the ability to go source opportunities for you. If we can't find opportunities or you're wanting to be more passive, we can find tenancy in common projects, Delaware statutory trusts, and even make recommendations on if you should talk to someone about a deferred sales trust. Yeah, so lots of different options in regards to that. But look, assume you sell the original property, right, for $1.5 million and you reinvest the proceeds of $1.425 million after selling costs into the new property, right? This is going to allow you to really unlock your equity. I'm going to break this down for you here very soon, but just in this scenario here, okay? So you've got current equity of 1.5 minus your selling costs, so you got 1.425. You can use those using 60% leverage on a property valued at $3.5 million if you put 40% down, right? And so the financials of the new property, let's just say you buy it at an 8% cap rate. You have your annual NOI of $285,000 here, right? This is very, very exciting because for simplicity, let's assume an interest-only loan at 5% interest rate. Okay, I know that we're not getting 5% interest rates right now, all right? I know that. But just for simplicity and for calculation methods, that's what you're using. So our annual interest payment is right around $106,000. So your NOI is going to be right around $178,000, okay? So that being said, sorry, that's your net income after debt service. The NOI was right at 285, but after debt service, it's at 178. So your new ROE on this project is 12.5%. And if you remember, our original ROE was 9.5% on this project. When we first bought it, it was 11%. Where we were sitting was 9.5% because it had gone down because of the factors that we've talked about. Unlocking this on the new ROE is 12.5%. Okay. So that's the simplicity matters. Let's do a side-by-side comparison, right? So if we go buy this property, right? The new ROE being the ROE that we had originally talked about. Okay. So just want to make that thing. So our initial market value for the property that we had, that we exchanged, was $1.5 million. The new one's 3.5, right? So we have our initial equity here. We've got our annual NOI of $90,000 on the first deal, $285 on the second deal. Our annual cash flow, we almost doubled. We went from $90,000 to $180,000. So it's not just return on equity that we're talking about. We're talking about actual cash flow that you can unlock through a 1031 exchange, right? So let's look at what those cash flows look like over 5 years. In the original property, that'd be right around $450,000. On the second property, we're talking about $890,000 here. Our final market value after 5 years, we go from having a property worth $1.7 million to a property worth $4.1 million. Our total appreciation is $238,000 on the original property and over $567,000 on the second property. So your equity at year 5 moves from 1.7 to $1.9 million. But your total return over 5 years is almost tripled here, right? We go from $688,000 to 1.5. And so we look at a return on equity over 5 years here on the initial scenario of 48%. And on the second one of 102.3%. So annualized, we moved from 9.67% to an ROE of 20.46%. We just took a property that was stabilized, that had appreciated, and was providing 9.5% return on equity. We traded that up. We increased the cash flow by double to $180,000, and we more than doubled the annual ROE, unlocking it through a 1031 exchange, right? And so I think that's really important to imagine. We have these conversations on a regular basis. Honestly, it's why we've done so many 1031 exchanges. We'll be speaking to somebody that owns a small multifamily property in California. Their appreciation has been way more than 3%. And they're sitting on, originally they had $500,000 of equity in the deal. And now they're sitting on $750,000 to $1 million of equity. And we have this quick conversation to say, well, what's your profit? Have your rents gone up double? No, I've only started to charge $100 or more every single year. So over the 5 years, they went from $2,000 a month to $2,500 a month. Well, you could take those funds, reinvest them in through a 1031 exchange, buy a $4 million property, put $1 million down, buy a $4 million property, and increase those cash flows substantially through a 1031 exchange. And this is a great representation of that. All right. I want to open it up for questions on you, Max. What did that example bring to your mind when you were thinking through that? You too, Nathan, because I know that this has been a very exciting thing for you to learn, and you've been using this for years now, but this really just brings this to light and allows us to really have these conversations with these property owners. Max, let's start with you, man. What was really stood out to you on return on equity here?
Yeah, to me, honestly, it's just, when you start looking at the numbers of what was to what could be, at the end of the day, that's our job as brokers, is bringing to light ignorance. And ignorance isn't bad. You just don't know what you don't know. And this is one of many ways, that we can shed light on a property. And Logan, I know you love this mindset, but everybody, anywhere you go, there's a story behind a person, a property, an event, whatever's happening. Until you really diagnose it, you don't know what other opportunities are inside. Mm-hmm. So that's what we love to do. That's what I love to do, is at the bare minimum, have the conversation. It's 20 minutes over your property, having that conversation worth potential returns that are double in 5 years, triple in 5 years? I think so. And so I just love seeing what the ROE can do for property owners.
Absolutely. It's a wealth creator. It's a wealth builder. It can really allow for growth. We pride ourselves on being problem finders and not necessarily just problem solvers. Mm-hmm. And I think that's really important as commercial real estate advisors, is we are problem finders, not just problem solvers. Yes, we can help solve problems, but we also like to help find those problems that maybe a property owner not even thinking about. Nathan, switching over to you, man. Give me your thoughts on ROE and the impacts that property owners need to be thinking about.
Yeah, really comes down to that investor's goals, right? I feel like most investors are looking at their cash flow or have started investing because they want wealth creation. Really understanding your ROE, or return on equity, allows you to increase that velocity of wealth creation, which is why it's probably the most important key financial metric out there that can be utilized. I would say the key players out there, if you're a syndication group or some sort of REIT, or you're working with high net worth individuals, they're using return on equity for a reason. When you're with the mom and pop owners or newer investors, they're not familiar with the term. But once they become familiar, it's going to be a metric that they continuously start using, because it helps with wealth creation.
Absolutely, guys. And the results don't lie. Here they are. We can run numbers for anyone that is interested in understanding the return on equity and what it might look like to unlock that ROE for growth through a 1031 exchange. Come see us. We've got some great events coming up this week, tomorrow night, Thursday, July 25th. CCC, Contractors, Closers, and Connections, here on the Plaza. Come see us. We'll be there from 4 to 8 p.m. Would love to meet you there. It's going to be a great event. They put on phenomenal events and great food, great people, always entertaining. really solid. We have our golf tournament coming up here as well. The Together We Win. This is our 3rd annual golf tournament. This one is supporting Operation Breakthrough, doing incredible things here in the Kansas City Metro. So that is on September 23rd. If you're interested in sponsorships, make sure to reach out to myself or for KD on the team. And for teams, they're going to go fast. I think we only have 3 or 4 teams still available. So definitely reach out to us. It's filling up quick. The course is in great shape. I went out and shot a 41 last Friday on the front 9. So I'm excited to do what I can do to help my team place as much as I can, but more importantly, raise a lot of money for a great nonprofit here. Additionally, we have some multifamily meetup groups coming up. So August 22nd, the Intercontinental Hotel here on the plaza, there is the Interface Kansas City Conference, and we will be there from 4:15 to 6:15 there at the bar. Outside of that, September, October, and January, we have our regular multifamily meetup groups at String Hall over in Overland Park, Old Overland Park, some of my favorite places to hang out in Old OP over there. So come see us. We'll be there representing the brand, talking deals, and meeting people. All right, got some questions about where they can go get started, how they can reach out to us. Okay, so go over to XChangeCommercialRealEstate.com. There's a Get Started. There is a Kansas City Deal Navigator, very easy to find on our website. You can find us on LinkedIn, Nathan Roberts, Max McQueen, Logan Freeman on LinkedIn on a regular basis. Make sure to reach out to us and connect with us. We're here to help you make the most strategic decisions on your properties. Look, I just saw a stat the other day. We are at a 50% low below the highest on the multifamily sales in Kansas City. We have not seen levels of transaction volumes to where they're at since 2010, okay, which is an indication that the bottom of the market is here or is very, very soon to be here. Basis levels tracking from the Green Street Property Price Index are right around COVID levels, so we're in a good spot. So if you have capital, you have a long-term vision, and you have the ability to take action when other people aren't, right now is a great time to get started. So make sure to reach out to us and make a connection. Get that conversation started. If you're a property owner interested in learning about return on equity on your project, reach out to us, and we'll happily consult with you to make your best decision on if you should refinance, lease it up, or sell that property and unlock it through a 1031 exchange. Thanks again, Max, for joining us. Nathan, for joining us. We're going to be here every 2 weeks coming to you live with the most up-to-date information in regards to what's going on in Kansas City, notable transactions, more of the property owner conversations that we are having on a regular basis with around education to help bring together all of this knowledge to help you make strategic decisions. So thank you again for joining us. If you're watching this on the replay, appreciate you being here. And we'll see you in 2 weeks. Bye-bye.
See you.
See y'all.